My name is Ian McKay, CEO at Invest in Canada. Now, our mandate is to promote, to facilitate, and to accelerate large-scale transformative investment projects into and all across Canada. As such, part of our mandate, of course, is to stay attuned to the shifts in the way investors are thinking, the challenges they face. And in that respect, I'm so looking forward to today's distinguished panel and their perspectives. The topic for the panel, as you heard from Jill, is the way we invest will never be the same. Now, that's a very jarring statement, but I think a highly appropriate theme at a time when global investment strategies are really undergoing a series of rapid change. To start with the big picture, both the OECD and the United Nations predicted that global investment flows will decline by 40% in 2020, and they will decline by a further 10% in 2021. And so this would bring it to the lowest levels we've seen in over 20 years. So while we know that normal investment flows will not be happening for the time being, it's never too early for governments, for multinationals, for investment funds, and investment agencies like ours to reassess the strategic plans and understand decision-making criteria. Now, we know that the pandemic has certainly exposed some vulnerabilities in the global supply chain that we've all become so reliant on. And of course, in some cases, that's been a catalyst for some positive change. And I would speak to Canada's experience with personal protective equipment. We discovered in March of this year that Canada only produced about 0.5% of our requirements for PPE. The government launched a call to action, about 1,000 companies responded, and 6 months later, we were at a stage where we were producing 50% of our PPE requirements, on a path, I think, to about 70% by the end of the year. So I think across all sectors, CEOs around the world are rethinking their global operations and perhaps trying to locate some of the components of the supply chains closer to the end user. Now, in our experience, one of the biggest changes in the operating of our client companies is how they make their final decisions. Site visits, in-person networking in the host country are going to be challenging for a little while. And so we've noticed that companies are increasing their remote research capacity. They're reaching out to my organization for accurate, relevant, and real-time data. And as well, at Invest in Canada, we're working with VR and AR companies in Canada to be able to host virtual site tours for our clients who can't come to Canada from all over the world. We are noticing since the pandemic at Invest in Canada a spike in interest from global investors in three distinct sectors of our economy. First is the digital economy. You know, if global supply chains are to adjust, if regionalization is in fact going to become more prominent, then jurisdictions like Canada, who have a demonstrated leadership and capacity in artificial intelligence, in AR and VR, in 3D technologies and printing, in blockchain, those jurisdictions will see a spike in inbound. These are the digital tools that will see an accelerated role in supply chain formation going forward. The second sector we're seeing a spike, of course, is life sciences. I don't think it's a stretch to say that the therapeutics and vaccines that will be deployed to combat the coronavirus will be as impactful to our generation as the polio vaccine was, as insulin and penicillin was to previous generations. And so in Canada, in the past 6 months, we're seeing a spike in life science-related investments into our country. And finally, clean technology. In Canada, governments are looking to leverage private and public sector investment in the next generation of clean tech solutions, whether that is hydrogen infrastructure for the hydrogen economy, whether it's electronic vehicles and the batteries that will propel them, whether it's renewable energy sources. Investing in this low carbon world is going to be critical to pursue this rather extraordinarily large economic opportunity that's in front of us. And I think in Canada we have the right ingredients for that, the raw materials, the highly skilled workforce, the innovative ecosystems, and of course the global market access. So Canada, I think, is poised to take a leadership role in this transition. And a final thought, the COVID pandemic we know is going to lead to new investor approaches and how they make decisions. I think there are some criteria that remain fundamental to the investment decision. Political and economic stability, an open mindset to free and fair-based, rules-based trade, and a truly global supply of workforce talent. And Canada has all of these advantages. So despite the uncertainty that we all know is in the short term, we are certain that the future is bright for those investors who continue to build and expand their operations in Canada. So with that, I want to thank you for your time and participation. I want to thank the Toronto Global Forum for putting on this super important session. And I will turn the proceedings over to the moderator for this amazingly distinguished panel, Mr. Frank Holder. Thank you very much.
Thank you, Ian. Very insightful comments, and good afternoon, morning, or evening to everyone. I'd like to start by introducing the panel, and I'm very excited that we put together such a distinguished panel and such a diverse panel in terms of their outlooks. I'll let them introduce themselves. So we'll start with Luke Ellis, the Chief Executive Officer of Man Group.
Hi, good afternoon or evening, everybody. So as you mentioned, I'm the Chief Executive of Man Group, which is a UK-listed global asset management business. We major on quant and discretionary. We are probably best known for the fact that we're the sort of, depending on your league table, third or fourth largest provider of hedge funds globally. But we also do a lot of high active share, high alpha, hopefully long-only products.
Thanks, Luke. The next panelist is Mohammed Alardi, who's the Executive Chairman of InvestCorp. Mohammed?
Thank you very much, Frank. And if I may say to everyone, best wishes to them and their families for safety and good health at these strange times. Mohammed Al-Ardi, I am the Executive Chairman of InvestCorp, which is a global investment firm in Bahrain, based in Bahrain, and we do alternatives, real estate, private equity, hedge funds, and credit. And we operate through the geographies, United States, Europe, the Gulf, and Asia and China.
Thanks, Mohammed. And last but not least is Neil Cunningham, who's the President and Chief Executive Officer of PSP Investments.
Thank you, Frank, and hello, everybody, and welcome to Canada. PSP is the pension fund for the Canadian Civil Service, RCMP, and the Canadian Army. We're roughly $185 billion under management, all with a long-term view, pay the liabilities from the defined benefit pension plans from those beneficiaries. So we've invested globally. Actually, about 80% of our money is invested outside Canada, and across all the spectrum of public equities, public fixed income, and roughly half our assets in various private asset classes.
Thank you, Neil. So I'm just going to dive right in. Ian mentioned a number of points that I thought were salient to this discussion, and it's true that it's a rather ominous title, right? The way we invest will never be the same. I would argue that that's generally true just about any time you look at it, but in this particular case, we were already going through some fairly significant disruption in the industry related to technology and the convergence of fintech with financial services and a number of other sort of issues, globalization, deleveraging, decoupling. There's just a wealth of things to talk about, and all of that before the COVID-19 pandemic, and all of that before the fact that there's a lot of uncertainty about sort of when it's going to end, if it's going to end, how it's going to end. So, because this has deeply affected the international markets and it's pushed investors beyond their traditional boundaries. And I'll start with you, Luke, with this question, but how is the operating landscape changing for investors, and how are you dealing with the consequences of the pandemic?
That's not a small question to start off with, but I think you have to look at a sort of combination of there are some big picture questions and then there are some technical questions. And a lot of the debate has tended to focus on the technical questions of, look, we're all now operating in a virtual world. Overnight I sent 1,500 people home and they started working from home. And, the great thing is with modern technology, if you've invested in your technology, it actually all worked perfectly well. But we're living in a digital distributed world. This conference is a good example of that, which is clearly very different. And investors, as we heard about on the opening remarks, if you want to go and look at a company or you want to go and do due diligence on a manager, you have to do it virtually now, and you have to rely on some sort of film techniques, whether it's normal ones or augmented reality or whatever. So, there's a lot on that technical side, which is different, and a lot of that's not going to go back, I don't think, ever. I think there'll be a lot less business travel to go and check things over after all of this than there was before. But at the same time, you've got some very big fundamental issues for investors around what's the position of bonds in a portfolio in a world where basically, bond yields in 2/3 of the world are now nothing. And what you saw during the crisis is government bonds didn't really provide a hedge to the sort of equity and growth risk in the rest of the portfolio. And, yes, it did a bit within the US and Canada because you have slightly higher rates than we have in Europe or out in Japan and beyond. But the reality of it is people are having to rethink the position of bonds in their portfolio. That means that the average client portfolio is riskier today than it has been historically because you're not getting the natural diversification. And I think that means that clients are really going to have to rethink their fundamental asset allocation. They're going to have to understand what other things than equity are bringing to the portfolio, whether they're bringing real diversification or just some market diversification. And that is going to, I think, challenge portfolios over the next, probably many years.
Thanks a lot. That's very incisive, Luke. And Mohammed, you spend your time between London, New York, and the Gulf. How do you see this? Is it any different from what Luke sees sitting in London? Do you have a different view on this?
I think as destructive as COVID has been to the global economy and to portfolios, because we have been for over a decade in that bull run, I think a lot of our investors have been sort of prepared for this because everyone was, waiting for a big correction. And so a lot of things that has been started before the pandemic of, prioritizing liquidity, ensuring a strong balance sheet, diversifying became really a help in as COVID hit. And I think while the panic started, but it was short-lived, and a lot of investors felt that this is not 2008, 2009 for sure. What we found is, there are those who want to wait and find that place between being conviction and concerned, and once they find that, they're happy to to deploy their capital. For instance, just a small example, in the last week we took one of our big retailers in Saudi Arabia to an IPO. It's a supermarket business. And for almost a week, it was over 50 times subscribed, and it kept growing like 10% every day. And so when investors find, even at this time, the right quality and the right sector, they do deploy their money in it.
Thank you, Mohammed. And Neil, for you, sitting in Canada, where we're virtually all today, and working in an industry that in some ways is outsized compared to the size of the economy, right? The Canadian pension funds are very, very robust, very well resourced, and as you point out, invest completely internationally. The majority of their assets in general are their investments. How do you see this?
So we certainly sometimes feel like we're quite large, and then we look at the global landscape of investors and we realize we're actually pretty small. If we waited until a potential investment opportunity got down from the largest down to us, then we wouldn't get very many opportunities. So we have to be a little bit more proactive. And size, I think at the size we are, we're in kind of a sweet spot that, we have a lot of global peers who frankly have to be everywhere because they just have that much money to invest. And then other smaller firms can be a lot more nimble, but they often can't get to scale in things that some things you need to be scale in order to take full advantage of. So, I like to say that our new strategy is that we're big enough to invest wherever we want, but we're smart enough not to. And it's a bit cheeky, but what it means is we really have to pick our spots and focus on, what it is we're good at, what we know, what we don't know, getting smart about who we partner with, and trying to be smart about the long-term trends. So in that sense, I'd say I like the drama of the title of this session, but I don't actually agree with it, because our way of investing is, to within a long-term strategy, looking at long-term trends, follow those trends and put the money to work on the long term, and look for opportunistic or tactical times when we can invest more, or, like Mohammed just described, take money out in an IPO, something like that. But that's not a difference in the way we invest. What we invest in and what the trends are and how the trends change, that has changed, and that will be changing. But to stick specifically, because I think we can get into some of those other things later, to stick specifically to the question of changing landscape, just add a few things to what Luke had said, and that is, when you talk about work from home, that's not a change in technology. We had that technology before. As Luke said, you take 1,500 people, you start working from home the next day because that technology existed. But that the genie's now out of the bottle for any employees or employers who felt that they needed to have everyone in the office in order to get things done. We now realize that for any kind of operational routine activities, those we can do fairly well from home, and I think our workforce has recognized that, and we're going to have to be a lot more flexible as employers for how we're going to deal with that diverse workforce. But we are finding that I think there's a lot of strain showing amongst a lot of people because not everyone has a work from home environment, which is ideal. We have gotten to meet everybody's kids and pets through video conferences over the last 8 months, but now we're going into dreary November, darker, wetter, colder, and less outside stuff. So mental health is going to become an issue that we all have to be thinking about, and any kind of activities which are creative, innovative in nature are harder to do from this virtual environment. So that's actually a very big focus of my time and something our executive are looking at. Otherwise, the externalities is obviously it's very difficult or we're not traveling, we're not meeting new people. It's very difficult to start new strategies and new relationships. We benefit from having offices in London, New York, and Hong Kong, and so we're able to maintain even, you're kind of at a distance, but at least nearby. So that's helpful. But it's, there's a timestamp on how long this work from home can be productive.
Thanks a lot, Neil and Luke. Neil mentioned some of this sort of work from home as being a challenge, and I think that's absolutely the case. What are some of the challenges, the main challenges, the investment management industry is facing today, sort of from where you said, and more in general?
Was that me?
Are you asking
Sorry,
that
this
of
is
me?
for Luke. Sorry.
No problem. I just, I mean, I guess one of the bits. So I must say, while I agreed completely with Neil in talking about the issues around looking after our people, the mental health issues, making sure people are in a good position, and that there's a lot more management required of us in order to be able to give different people different setups. I have to say, on the other side, I don't buy this thing that people are less creative when they're at home or when they're working digitally or virtually. I think that there is a whole generation of people, and it's sort of, maybe it's anybody under 35 who has got used to dealing with all of their relationships, got used to making plans, got used to being creative in a virtual format, in a digital format. And, you know, we've certainly found that our model creation, so new models being developed, brand new out of the box in the work from home environment, has been just as quick and actually about 10% more productive than when we're in the office. And, you know, I think, you know, it's interesting whether there's it, but, you know, we do enough of it that it's statistically significant, that 10% pickup. And it comes from the fact that a lot of people really like the quiet time and are not necessarily keen on the conversations the whole time. I think, getting to your question, that there's a big issue that we're all facing as investors today, where, you know, governments have made it very clear that they're willing to throw enormous amounts of money at any sign of a part of a particular economy that's not working. And, you know, we had the last, or maybe the one before, election in the UK, there was a thing where the right-wing party accused the left-wing party of having, you know, believing in a magic money tree, and that they were going to write checks for things and they'd never be able to fund it. Well, every government in the world has come up with a magic money tree in the last 6 months, and I recognize why that was necessary, but it's almost impossible to get that sort of genie back into the bottle to convince politicians, governments, that they can't just keep spending money whenever there's an issue. And so we end up in this really interesting world where judging whether a company is a winner out of this is a loser, or is a loser where the government is going to go and fund them, give them money, and turn them into the winner, even though they might have the worst business model, is a really challenging question, because it's not an efficient clearing market anymore, because you have an actor who is, let's call it, not financially motivated. So I think that's an area where we're all going to have to make some judgments, and we're going to get some things right and some things wrong, where, you know, this particular airline is the least productive within a market, ought to be the one which goes under, leaving better profits for the airlines that can keep going, that are better funded. But then if the first one is a national champion of some particular government, maybe they'll save that, and suddenly the better run airline is the one that goes out of business. I'll pass it back.
Yeah, that's pretty terrifying, the way you describe it. I really wish I had a magic money tree, but then I have to ask who's going to pay for it, right? The magic money. And so, Mohammed, how do you see it? You know, in emerging markets around the world, political risk and macroeconomic risk go hand in hand. That's now everywhere. And part of it is, you know, what Luke was speaking to earlier. But do you see this as a challenge? Do you see any competitive advantages in having experience dealing with these kinds of more turbulent environments, or is it all downside?
I mean, first of all, I want to agree with what Luke said about, people, sending at the beginning of this pandemic, I think everyone has, led by making our people, the priority in their health and safety of their families. Then come the challenge of really looking after them while they're doing this, because working virtually became maybe working not less hard, but more hard for many people with their, with the circumstances of children and kids and looking after a family. So I think that is something that we need to look after now. Of course, as we want to see the end of the pandemic, is again how to close this cycle and how to operate maybe back to the office or in a hybrid situation, but in an environment where governments need to send people to school but make schools safe. Otherwise, parents need to stay home. So I think this uncertainty is a challenge. I think like you said, I think as businesses and investors, we're not really very good at calculating what politics is going to do, what geopolitics is going to happen, and yes, the advanced economies and the sophisticated part of global economies managed to navigate this through and looked at opportunities, took some of the downside, but also leveraged on the opportunities. But also there are, there is a big part of the global economy that is not as sophisticated. A lot of people lost their jobs, a lot of bankruptcies we don't hear about. And I think the challenge to see how is that going to pan out later on when government is maybe not all governments is able to keep spending money like others. I think these uncertainties are definitely are challenges to think about.
Thank you very much. And Neil, how are investor portfolios changing, and what positions are proving to be riskier than others in this environment?
So it's interesting. We as I listen to Luke, and a lot of what he runs is hedge fund and quant portfolios, which tend to be more shorter term oriented. And what we're doing is quite long term oriented. And so one of our biggest challenges is frankly separating the noise from the long term trends. And I never really thought about it until I was listening to Luke, that think that he kind of operates in the noise. And a lot of the quant strategies are probably designed to trade in and out in the noisy parts of the spectrum. And we try to be much further out on the longer term trends and decide. For us, it's more, the biggest issue is identifying what's noise and what's a trend. I would say today that as noisy as it is, the U.S. election is largely noise to us as a long-term investor. There are some trends behind it, but we're much more concerned with the trends of that get accelerated by COVID. And so we saw the acceleration of deglobalization, which is an offshoot of populism, or maybe one's the offshoot of the other. E-tailing, work from home we talked about already, pace of disruption, which was mentioned already. So these are interesting trends. But the one which probably has affected portfolio construction the most is one that Luke mentioned earlier, and that is fixed income is no longer fulfilling its role in the portfolio that it traditionally has as an offset against the equity portfolio. If you think of that classic 60-40 split, and with fixed income generating basically no return, that it's not able to provide that offset to a down market in equities. And so we've had to look for what alternatives can we have to replicate what fixed income was meant to do in the portfolio. So what we're actually doing is we're reducing our global government bond portfolio, but we're increasing in things like, and we're definitely adding risk when we do this, in emerging market debt, private credit, and in high inflation linked infrastructure projects, which hopefully have little to no operating risk and little to no credit risk. At the same time as we do that, we fund it by reducing our fixed income, but we also reduce our equity portfolio to offset, to stay within our risk limits. The other thing we're doing, and it may seem counterintuitive in the context of global geopolitics, but we're very much increasing our allocation towards the east, towards Australasia, and towards emerging markets to try to capture. Now that's different from fixed income, but that's the geopolitical long-term trend that we see, that part of the world is just going to generate that much more of the long-term economic benefits.
Thanks a lot. That's very insightful. Luke, anything to add to that from the noisy section of the economy?
Well, look, I was smiling a lot as Neil said that, because our biggest strategy is a trend-following strategy, which is so I guess we're always trying to pick the trend from the noise as well. Just he's right, on a different timescale, on a 3 to 6 month timescale rather than a 3 to 10 year timescale. And I think on the longer timescale, as I brought up the bond one earlier, I completely agree that is a real challenge, and people have to look at government bonds as a trading opportunity. I don't think you can go short government bonds on a consistent basis, but you definitely don't want to be just sitting long and hoping that it will work out for you. Against that, I think the one big question which has been brought into stark relief in the course of the last year, and the pandemic has made it worse, and the election in the US, I would agree with Neil, it doesn't really matter which side wins. I think the same thing, which is US versus China. Over the next 10 years, I think the outcome for many portfolios is going to be decided by what position do they take on that question, and particularly the question on, is a China allocation supposed to be very small because it continues to be a place where they don't let shareholders, or particularly external shareholders to China, make a reasonable return? Or actually, is it something that's supposed to be 40% of your portfolio because really China is, well, we know it's the second largest economy today. If you look at growth rates and anybody's projection on growth rates, it's going to become the largest economy and could therefore be the number one driver, a bit as Neil mentioned with Asia. But really that question comes down to China and what returns are they going to let people have. And I think that's true for investors, and it's true for asset managers, where you have to make decisions about whether to make a significant commitment in the region or whether to stick to the US. And, what's clear is the mood music from both the US government and the Chinese government is you have to pick a side. And the UK is trying very hard to stay friends with both sides, but seems to be at risk of making enemies of both sides. And, at the moment, both governments are going for you're on my team or you're my enemy. And that, if that continues, is going to make investing much harder over the next 10 years than it was over the globalization period.
Thank you. That sounds like a real existential threat in some ways, and it's very clear that the trend at least has been in that direction. Yes, I see Neil raise his hand using our super secret method to ask questions.
So Luke, interesting question on the that last point you made about picking sides and being on one side or the other. Do you think the U.S. election potentially changes the rhetoric there, that a Biden presidency would be much more likely to work with allies and basically agree on the things that they can work with China on, and then agree on the things that they can't, but it would be much less binary and confrontational?
I think that the rhetoric will be calmer if we get a Biden victory, but I think the direction of travel will be very much the same. And in some ways, the Chinese hoped that for all of the noise and the craziness from Trump, he was a deal maker. And so they were willing to put up, in their mind, with a lot of the aggression in return for being able to make deals which would give them what they wanted. They've really, in the last year, worked out Trump isn't a deal maker. He's just full of noise as far as it comes to China. And everywhere in the US establishment is as far as I can see, is in the same place, that China is something which has to be beaten rather than something that they want to work with. And, when you talk to people in China, they don't like that rhetoric at all. And, if you give them a choice of being beaten or being a sort of pliant partner, well, they're not going to take those choices, and they are very much here. We have I've lost track of which one of the 5-year, but it's the latest of the 5-year plan. They have the meeting going on as we speak. And it's very clear that what's going to come out of that is self-sufficiency and an ability to withstand anything that the US will throw at them, either from trade point of view or other points of view, all the way through to militarily. The Chinese are definitely not of the opinion that Biden will make life easier for them.
Yeah, I have to agree with you. There seems to be broad alignment across the political spectrum in the United States with regards to China. And clearly, even though there will be some differences, I'm not sure they will be substantive. So, Mohammed, I was going to ask you what you see in terms of changing portfolio and risk, but also go to our last question as well, being cognizant of time, and ask you how you think investors can prepare for the challenges ahead and turn these challenges into actual advantages. So those are kind of two sides of the same coin in terms of a question.
Thank you. Well, we're seeing in the private investment, for sure, private equity, real estate, credit, a lot of dry powder coming in as investors, look for more yield to respond to, their future needs, and this is making, the private equity in particular more democratized, more open for retail investors, and allowing more opportunities and deployment to happen. I think it is obvious to say that investors are already looking at anything that is vulnerable to things like the pandemic and trying to change. So anything to do with technology is good. Anything to do with healthcare, anything, ESG is taking a big part. In fact, investing is something the pandemic has made more clear for people to relate to. And so the other thing, I think, to maybe the last question about the risks, I think not diversifying has certainly become a really big risk, as we saw in the pandemic, and for a region for instance, like the Gulf region, where oil and gas is the main commodity. When oil prices, fell, and then the pandemic came, it was like a double whammy for it. So investors, really understand more than any time before the need to diversify, not just in sectors, but also geographies. And this has helped, during this pandemic, because the way the wave has worked is, started in China and continued west. And so every economy that clears that wave starts performing and start returning to near normal. And so diversifying in those geographies have really helped portfolios.
Thank you very much. So Neil, what do you think about challenges and opportunities? I mean, you've talked a little bit about it, but what's the bottom line if this decoupling occurs, or this sort of thesis that things will continue to be difficult between the world's two largest economies? Where do you see the challenges and the opportunities for your nimble, medium-sized amount of money to invest?
So I guess I would say that even though I said we're trying to be smart enough not to invest everywhere, it's really humbling to try to be smart enough to anticipate what's going to happen, because it seems inevitable that things never really turn out the way we expect them to. And Mohammed is dead right in saying diversification is the name of the game. I'll give you a brief anecdote. We invested last December in a UK pub business. At a time, when we did our underwriting, we said, what can happen to a UK pub business? I mean, they never shut down even during the Blitz and a couple of world wars. So surely, we don't have to worry about a shutdown. And, what happened 3 months later. So, unless you diversify into both geographically and by sector, you're bound to get hit by something you didn't expect. And then the other thing, which is fundamental, I shouldn't even have to say it, is you got to make sure that you're going to be able to remain liquid in some kind of a downturn, regardless of what causes it. And you're never going to know what caused it, because every downturn is different. The cause is always different. The end result is we eventually get out of it. And so you need to survive it to get out of it. And there's always something we can learn. But in this case, I think you need to be focused on what are and Luke is right. We are trend investors. We try to see what trends are forming over the next long period of time. Clearly, AI, healthcare, biotech, as Ian was talking at the beginning. But also, I think we need to be looking at companies who are seriously spending time and effort on inclusion and diversity and on ESG factors, because increasingly, whether it's employees or customers or governments, are going to be looking at those factors in determining where they work, where they shop, or where they legislate. But that, to me, it's a long-term trend that we need to follow.
Thanks a lot, Neil. And we're just about out of time. So, Luke, I'm going to give you the last word, as long as it's a brief one.
Well, if I come back to what you said at the beginning, where you said things are all completely different this time, I was taught that the most dangerous thing to say in investing is this time is different, and that mostly it's an extension of what we've seen before. So that's where I think Neil's long-term trends are the right way to think about for how you position your portfolio. And you just want to make sure that if it is different, you can get the heck out of Dodge and have a very different portfolio, and differ enough, quickly enough, that you can actually protect yourself.
Well, Mohammed, Neil, Luke, thank you very much for your time. That was very insightful, and I'll turn it back over to the forum. Thanks a lot.
Thank you all.
Thank you.